What if I told you everything you've been taught about investing is wrong? The rich aren't playing by the same rules as everyone else. And today, I'm exposing the 5 biggest investing myths that keep ordinary people poor. Myth number 3 will shock you. It's costing you thousands every single year without you even realizing it. Most people never build wealth because they believe investing myths that simply aren't true. These misconceptions keep them stuck in the paycheck cycle, while the wealthy use completely different strategies. Today, I'll show you exactly what works versus what doesn't. We'll look at real data, not opinions, to prove why these myths are costing you money. By the end, you'll know how to invest like the rich do, starting with whatever amount you have right now. The first myth is that you need thousands to start investing. Many people won't even begin because they think it takes a big lump sum. That couldn't be further from the truth. Let's say you put aside $10 every week. That's less than most people spend on coffee. At 7% annual growth, which is roughly the stock market average, you'd have over $3,000 in 5 years. Keep going for 30 years, and that $10 weekly becomes $61,000. Fractional shares changed everything. Today you can buy pieces of stocks for as little as $1 through apps. Want to invest in expensive stocks like Amazon or Google? You don't need thousands per share. You can own a slice for whatever you can afford. Successful investors often start small. Warren Buffett bought his first stock at age 11 with money he'd saved. The wealthy know it's not about the initial amount. It's about building the habit early and letting time work for you. As Wesleyan notes, by setting up a direct debit and investing a small amount each month, you can steadily build up your pot. That's the real secret. Automated investing turns small amounts into significant sums without you needing to think about it. Now let's look at why many think investing is too risky and why that's another myth keeping people poor. Many people believe investing is just gambling with your money, which keeps them from ever starting. They imagine losing everything in a market crash, so they keep cash in savings accounts instead. But here's what actually happens. Inflation quietly eats away at that money over time. As Wesleyan notes, if you leave £10,000 in a savings account earning 2% while inflation is running at 5%, your money's purchasing power is effectively shrinking. The stock market may seem risky day to day, but the long-term trends tell a different story. Compare that to inflation averaging around 2 to 3%. That gap makes a massive difference over time. As Wesleyan explains, this means spreading your money across different companies, sectors, and asset types like shares and bonds. This strategy reduces risk while still capturing market growth. The key is staying invested through market ups and downs. Short-term dips don't matter if you're investing for retirement or other long-term goals. Historically, markets always recover and continue growing. Those who panic and sell often lock in losses, while those who stay the course see their investments grow. By automating investments into diversified funds, you remove emotion from the process. Set up recurring transfers and let the market do its work over time. Next, we'll examine why real estate isn't the only smart investment path many claim it to be. Social media makes it seem like becoming a real estate mogul is the only path to wealth. But direct property ownership comes with hidden costs that most people don't consider. Property taxes, insurance, maintenance, and vacancies can eat into your profits. Unlike what you see online, rental properties aren't passive income. Dealing with repairs, tenant issues, and months when the property sits empty turns it into a second job. REITs solve these problems while still giving you real estate exposure. They pool money from many investors to buy apartment buildings, offices, and shopping centers. You get diversification across many properties without the headaches of being a landlord. REITs trade on stock exchanges, so you can buy or sell them anytime. With direct ownership, selling a property can take months and cost thousands in fees. The numbers show REITs perform just as well as owning rentals, sometimes better. While rental property returns fluctuate based on location and local markets, REITs spread risk across many properties and regions. REITs provide a more accessible and liquid alternative, allowing you to invest in real estate without the large upfront costs. Institutions like pension funds invest in REITs for this reason. Billionaires use REITs too. They know direct ownership isn't always the best option. The key is building wealth efficiently, not just following trends. Next, we'll look at the most dangerous myth, the idea that you need to time the market perfectly to succeed. This has been Compound Clarity. Leave a comment, like, and subscribe.